It is my hope that this little video will bring the death of the current way in which 401k plans are designed with regard to participant direction, and just how bad the target date and lifestyle funds really are for 401k plans. And then I'll show you an alternative, the dynamic asset allocation portfolios we designed for our clients' 401ks as their appointed ERISA 338 fiduciary investment manager. This is what I believe is going to be the future of 401ks, the fiduciary manager directed with participant input 401k plan with the dynamic asset allocation portfolios. First, a little background. Since the early 1980s, when participant direction of the investments within a 401k became the prevailing method of plan design, the results have been, well, terrible. It's been a blessing but also a curse, because a point can be made at having a participant's investments more closely matching his or her investment needs. But the fact is, just as I said in a prior video, we don't teach people how to manage the money they earn in their jobs. Even the late Louis Rukeyser, in his famous book, What's Ahead for the Economy, complained about this problem back in 1983. And nothing's changed since either. Giving people interest-thick enrollment kits doesn't help, and there are dozens of free web-based retirement calculators that people can use. But in 2003, I was shown the results of an annual survey and research sponsored by the firm called Dalbar. Their research showed where from 1982 to 2002, during the longest peacetime economic expansion in American history, the average stock fund investor had earned only an average annual return of 2.6% per year, while the S&P 500 had earned an average annual return of 12.6%. Dalbar has generated this same report each year since then with updated data, and the results have changed very little. They report that it is not so much the investments themselves that causes such lousy results, but investor behavior. And 401ks have suffered from the same investor behavior. When I've looked at plans year over year, I see average returns only in the 5 to 6% range, when the stock markets were doing double that. But before I jump into the DAAP models, let's touch on the latest fads in the retirement plan industry that are attempts to rectify the situation, the lifestyle and target date funds. In my industry, we've known for years that the results have been so poor. So roughly 10 or so years ago, the first target date and lifestyle fund offerings were created by the mega mutual fund families. Look, the only reason these things exist is because of the rarity of ERISA 338 fiduciary investment managers in this country for 401k plans. And there's tons of money in 401ks to attract these people to build these types of funds. But the performance of these fund offerings has been mediocre at best, and their reported standard deviations are through the roof, way too high for retirement plan accounts. And here's why. What both the lifestyle and target date funds have in common is that they are built from mutual funds from the mega mutual fund family's set of already existing mutual funds, and oftentimes not from their best funds either. So already somebody is investing in these fund types and they're paying a couple of extra layers of expenses that is a drag on their potential return, and they're not getting the best managers for the money. And people misuse them. In fact, in my consults, about 25% of participants who use a target date or lifestyle fund pick at least one more fund option as part of their portfolio of investments. You're not supposed to do that. Next, lifestyle funds often go by the names like aggressive growth or income. And it is not uncommon for me to see a 62-year-old using an aggressive growth fund thinking that he wants to get the most return for his money, like he's shopping or something. And then the market takes a serious tumble like it did last year, and now this 62-year-old has a 401k balance that's half the size it once was. I've seen it. I see it a lot more than I care to. And as for those target date funds, how on earth, or rather why on earth, would anybody submit to some blind computer program automatically limiting their potential to growing their money when in fact they may not be able to afford such a restriction in the first place? That's beyond me. And how on earth are you supposed to project what your returns are going to be for, say, the next 10 years and set goals for your retirement balance with a target date fund? The answer? You can't. Not with a portfolio that keeps moving around. And just like the computer-generated asset allocation advice programs that some of the Novo co-fiduciary advisors are using, none of these target date or lifestyle fund managers, at least the people I've spent time listening to, recognize the Austrian business cycle. There are going to be whole decades when these funds do very poorly, and right now we're in the middle of what I call the winter phase of the cycle. And it's not a very good time to be using a paradigm that's 60 years old that touts only using stocks and bonds. These fund styles don't help you in integrating an employee's long-range vision of themselves with your company. Now, isn't that why you've installed a 401k in the first place? Tell me, how is having a lifestyle fund ever going to convince an employee that you are indeed a life partner long after they retire? Well, we have a realistic, verifiable, and repeatable solution, and it is the dynamic asset allocation portfolios. There are 7 models utilizing 13 asset classes and research from various internal and external sources. How they work is this. We classify employees into what we call 5 life bands, where within each life band there are 3 models that are most suitable: conservative, moderate, and aggressive. As the employee ages, he or she will shift to the next life band, such that while in one life band a particular model may be considered conservative, in the corresponding life band nearer to retirement, the same model might be considered as moderate. And in the next life band, that same model might be considered as aggressive. This means that the 7 models actually work like 15 models. So there's no reason to have 9 bazillion models. That's only trying to find a way to hide from scrutiny. And DAAP models give me the ability to manage the process of model construction and ongoing oversight, such that, for example, as in 2008, when I determined that the economy was shifting towards economic Austrian winter, I likewise shifted the models away from stocks. Over the years, this has served my clients quite well, with better returns and lower risk, especially when comparing the DAAP models over the major target date funds, where you'll see that even their most conservative models are loaded with stocks. Now, don't get me wrong here. Personally, I'm a constitutionalist and somewhat of a libertarian. I think people should have a choice. But in William Bernstein's book, The Intelligent Asset Allocator, he shows how asset allocation modeling has been proven to reduce risk and get people better returns. And that started not by his research, but a huge mutual fund company. The DAAP models have a 5.5-year track record of outperforming the major target date and lifestyle funds each year since 2004. This is because we prefer to use record keepers that have access to virtually any mutual fund available, so we can pick the best mutual funds available out of 27,000 mutual funds and share classes in each asset class we use inside the models. And we are able to do this with substantially lower risk or standard deviation than the target date and lifestyle funds. If you look on our spreadsheet that you can pull down from our website, you'll see why. These target date funds are loaded to the gills with stocks, yet they can't outperform our models. And I'm telling you, right now is not the time for that. The DAAP models combine only the best attributes of target date and lifestyle fund offerings without the negative drawbacks. With the DAAP model portfolios, a participant's investments become more conservative, but only when he or she and their retirement coach, using the retirement coach system software, jointly agree and decide to make it more conservative based on factual data about that participant's particular needs, and not some blind computer program making arbitrary decisions. You can pick up a fact sheet on the performances of the DAAP models by going to our website and look under the links section. Thank you for viewing, and I look forward to speaking with you.